Thank you very much. Good morning, ladies and gentlemen. I'm very pleased to be here, but even more than that, I'm pleased to see so many people interested in fintech. And for the purpose of this panel, I think we should define fintech because so many people mean different things when they say fintech. So, first of all, fintech initially started as a mix-up of financial and technology, meaning basically a technological function in the finance sector. But more and more times, people meaning fintech mean companies, especially young startups, such as the ones presented here, that's actually trying to approach finance in a different way. And we have a number of companies here representing different areas. We have equity capital markets being represented by Tero, and I think also investment world. We have David representing remittances and payments. We have Srini representing credit scoring. And we have Yanis from Latvia representing peer-to-peer lending and debt capital market in general. And I think we'll start with some presentations.
Hi, so my name is David. I'm originally from Taiwan, but I moved to Luxembourg 2 months ago from Nairobi, where I used to stay for 3 years. So I would like to, before I introduce what BPESA is, I just want to start with a short story. So I moved to Nairobi 3 years ago. And my mom asked me, after I moved there, it's like, do you have shampoo there? Can you take a shower? Like, do you have hot shower there? A lot of people have like this impression about Africa, which is, like if you haven't been to Africa continent, you will not expect that you have like skyscrapers in Nairobi and like high-speed railways there. And the one thing fascinates me is that the mobile payments and the local payment is so efficient in Nairobi in Kenya, where you can instantly pay other people on your mobile phone. And when I moved to Luxembourg 2 months ago, I went to this gigantic supermarket where you need to queue and get a number card to get your seafood. But when I when I went to Berlin last week, I couldn't even pay with my credit card. I need to get a Maestro card or cash to do that. So the question led to this venture BPESA is creating is, why do we have this so efficient infrastructure? In fact, we're sitting in these fancy buildings on the consumer innovation, but there's limited innovation when it comes to actual infrastructure and when it comes to B2B, business-to-business payment. And one of the problems we started to ask ourselves is in frontier markets where you see Africa, or Latin America or Southeast Asia, these markets often connect to the world with G20 currency or G10 currency. So you have to buy dollars in local currency and then transfer to your business counterpart or suppliers. You cannot just trade with your Kenyan shillings or Nigerian naira. And if you go to Kenyan banks, you cannot buy Nigerian naira. You have to buy dollar first before you can get to another currency. And that is a huge problem because it's very expensive to send money into, from, and between Africa. It's very, very slow. It takes days to weeks, and it's not convenient. And we've seen some solutions in the market, like Hawala Network, which this word originated from Somalia, where basically I give you cash and you call your family in the United States or in Taiwan and give you cash, right? So this ledger, kind of similar to the complementary currency system we just talked about, or another digital solution called TransferWise, we're in Europe. And we, as a company, BPESA, is operating in this hybrid model where we incorporated in major African economy in Nairobi, Kenya, Uganda, Tanzania, DRC, Nigeria, and Senegal, and we open our own bank account and we trade these currencies. We enable business to buy and sell African currency easier. We connect to bank switches, we connect to mobile wallets, we don't do cash. But outside of these countries where we own our own infrastructure, we can simply send Bitcoin to my counterpart to Bitcoin exchange in China, in Japan, in Latin America, in Europe to get liquidity, and then help my client to liquidate those Bitcoin into a fiat currency directly, and the transaction is fast, it's cheap, and it's convenient. So we're one of the fortunate companies that in Africa that get funded really well and supported by global investors, including Graphcroft, Draper Associates, Team Draper, Plug and Play. So we've just closed on that round, and it brings our total equity funding up to date $10 million in total. And we started a company 3 years ago. And this is a customer that we work with. So we do B2B payments or B2C payments. So a customer in Kenya want to pay their suppliers in China, they will give us a local currency. And we make a market for them in Chinese yen or Japanese yen or vice versa. And one interesting use case that I want to mention is this Jumia, which is funded by Rocket Internet. As mentioned in the previous panel, they exactly owns a lot of data for consumers or merchants on the continent, and they want to start providing lending. And if you want to do a global lending platform, the first thing you're going to think about is how can I disperse payment? How am I going to disperse my loans to the merchant or to the person, and how can I collect back in the most efficient infrastructure? And the blockchain technology and blockchain, this open source data, open source ledger comes into play when in this use case. So how does actually this work? So I want to draw a quick fun flow just to show you how this actually works. So imagine there's a multinational, this is a real case, a real customer we deal with. Imagine a multinational companies, they have subsidiaries in different African countries, in particular Nigeria, where we have the largest market right now. They will basically say, hey, I want to sell my Nigerian naira. Who can buy it? So BitPesa will come and say, I want to buy your Nigerian naira in this price. So they will send us local currency Nigeria to our local bank accounts, and we immediately make a market for them to buy euro on here. And on both ways, it's all settled through the local settling system. In Nigeria, it's NIPOS. In Europe, it's SEPA. Another example is the other way around, like a company want to buy African currency. So again, people will say, hey, I want to buy naira, I want to buy Uganda shillings, I want to buy Kenyan shillings, who can sell me? And BitPesa will say, hey, I will buy your euro and sell you African currency directly settled to your local bank accounts. And another question we got to ask a lot is, how do you deal with compliance? How do you make sure you're not sponsoring, you're not supporting terrorist financing, or how do you do that? And it's very simple. We are not reinventing the wheel. Compliance has been part of banking or financial services for ages. It's just about treating your customer well, knowing your customers, collecting the data, and comply with the regulator. So we are, in fact, licensed by FCA, one of the first companies that use fiat currency and also blockchain technology to make a market for payment, and licensed by FCA and then CSSF in Luxembourg. And we're working closely with the regulators, especially in Nigeria, to publish could be the first country to regulate cryptocurrency or and blockchain companies on the continent. We don't stop here. We just closed the funding and we want to expand further to Middle East and North Africa. So right now we have 6 markets on the continents, and we are expanding to Egypt, Morocco, and Middle East, Lebanon, Dubai. That's our story. Thanks.
Yeah, thank you. My name is Tero Weckroth. I'm from Investor, and that was really fascinating and exciting story. Thank you for that. I probably agree with you on everything, but I have very different perspective, and the conclusions might be just the opposite. Before I start, let me ask, is anyone here from a bank, traditional bank? Hands up. Anyone from Cedars? A crowdfunding platform? No. Anyone from regulators? Okay, good. Anyone from World Economic Forum? Okay, good, because I'm going to say some bad things about all of those. Also, thank you for being here, for inviting me here, and also apologies, I need to leave very swiftly after this because I have a presentation in Helsinki tonight. But my perspective, I'll talk quite a lot on the first and the last slides and go the others quite quickly. Well, I'm from Finland, a country with crowdfunding regulation or crowdfunding law that I think Oliver mentioned earlier. I'm chairman of a crowdfunding platform, which is a fintech company, and talking in an alternative finance forum. Well, I don't think crowdfunding law is necessary. I don't think it should exist. I think crowdfunding as such is a bad word. I don't think crowdfunding really exists. It just means that something is done on a smaller scale than before. Fintech, Well, somebody said perhaps you understand, hopefully you understand. I don't think this is rock science. We are a fintech company, but I don't think we really do much technology. It's quite simple stuff. And alternative finance, I think that's a bad word as well. I think we might just talk about better finance, because banking will always be there. If it's Facebook, like somebody said in the earlier presentation, well, that's still banking. And we all live in alternative finance space because the bankers and the regulators and banks have been slow and arrogant. That's the bad words I wanted to say there. So what we are doing, we are equity and debt platform for listed and unlisted companies from Nordic countries and the UK. So the companies who issue securities, very traditional word, issuing securities, is a MiFID term. The companies can be domiciled in any of the Nordic countries or UK. And then investors can come from anywhere in the world. We haven't had a case like that, but I guess if somebody from North Korea has a credit card and wants to invest, it's fine, as long as they pass the money laundering tests and all KYCs that we have in place. On the next one, what Investor has done in the past, here are a few achievements. I just want to mention the fourth and the fifth one. We were the first one to make a IPO, so we were a subscription site for a real IPO in a listed exchange as a crowdfunding platform. And also the second last point, and this is the Cedars point, we were the first platform to first complete a crowdfunding round, or what is called a crowdfunding round, a target company which was called Heros, a fintech company itself. And then a year later, we executed a IPO in a regulated market for the same company. This happened in October 2016, closed in the first days of November. Actually, Cedars keeps telling that they were the first one to do a thing like that. They just haven't been to Finland. We did it before them. Quite a lot of publications of the sector have corrected this mistake, but if you know anyone from Cedars, please ask them to correct their own communication as well, because this time UK was not the first. We in little Finland did that before. The last point is what I will do tonight. We will launch a transparent index to follow the post-round performance of capital invested in equity via Investor. We believe this is a global first. Very happy to be proven wrong. We have not found any other index like that. On the business model, I was asked to say a few words. It's quite traditional in like typical equity crowdfunding model. We take fixed fees, like listing fees. If you want to show up in the platform, that is there's a fixed fee for that. Then we take a percentage of the capital raised. What we are moving towards is that we are going to create recurring revenue from the post-round services, which goes a little bit to the e-wallets direction, so that if you have in the traditional finance space, if you are SME in anywhere like here in Poland and you have 300 shareholders across the EU, you need to pay dividend for them. Somebody, grandmother in Ireland, might end up getting 10 euros. You don't want to do that by a traditional banking system. So we will be able to allocate that capital to the e-wallets of the investors. This is going to be an important part of our business model. It hasn't been there yet, but it will be. Then finally, on the World Economic Forum, I hope you can read the final two bullets there. This is from a very, very good and recommendable reports from World Economic Forum. They come out about every year or two, worth reading. On equity crowdfunding, they said that the crowd has proven less wise than expected, and that equity crowdfunding remains disconnected from the broader financial system. I strongly disagree with both statements, even if it's excellent report otherwise. We have, in all the rounds, we have a Q&A. So if you are CEO of a company who wants to raise $1 million from the crowd via Investor, any investor is able to grill the CEO of the company in the open public Q&A. platform, which is like a Facebook chat, but it is just on our platform. And then the CEO is expected to answer. And we have seen cases where problems in the business model and forecast have been exposed quite ruthlessly here, much better than a typical investment banker sitting in his, behind his desk would have done in a DD. So we use the crowd, wisdom of the crowd, I think very well, but still it's not fintech or rocket science, it's just giving people a voice. And then secondly, I think we have very much proven that we are part of the broader financial system with doing IPOs for the crowdfunding equities. And this is my last point. We really, whatever we do as fintech, it's just early signs or early days of what tomorrow will be typical normal finance banking. Perhaps Facebook will be the biggest bank in the world, but it's still a bank.
Thank you, Taro. Very interesting thoughts. Let's move over to the next presentation.
Hey everybody. So my name is Jan Spranievich and I'm head of loan originator partnerships at Mintos. So at Mintos we have built a marketplace for loans where we connect investors on one hand with the non-bank lenders, alternative lenders, microfinance organizations. You choose the name. Okay, how does this work? All right. So why should you care about Mintos marketplace funding? Basically, for alternative lending companies, this is a very flexible source of funding. A source of funding which instills a lot of flexibility in the funding structure of an alternative lender and also instills a lot of scalability into that funding structure. The marketplace has very deep liquidity. As of the moment, more than 300 million euros in loans have been funded by 34,000 retail investors and almost 30 alternative lenders, or loan originators as we call them, use the marketplace to fund part of the loans they are issuing. And it's easy to join. Takes a few months to join, and once the initial setup is done, it's very easy to use and fund part of the loan issuance through Mintos Marketplace. So what's the business model? As mentioned, we connect investors on one hand. Investors are mostly retail investors, which come from more than 60 countries. The average portfolio size is a few thousand euros for those investors, and you could call them young urban professionals. And on the other side of our marketplace are loan originators or alternative lenders. Businesses whose business is to issue loans, but they are not a bank. These loan originators issue a variety of loans. They can be mortgage loans, unsecured loans, invoice financing, agricultural loans. So basically any type of loan can be funded through Mintos Marketplace. And obviously each of those loan originators has its own set of borrowers. So what are the key benefits of funding part of the loans, part of your issuance through Mintos Marketplace? Mintos Marketplace is very flexible. So, for example, contrary to traditional sources of funding like bank loans or bond financing, which tends to come in large, bulky rounds, which is on one hand cool to receive this large, bulky round, but on the other hand, when you receive this large, bulky round, it often surpasses your immediate loan origination volumes. So you keep this large, bulky round on your balance sheet, and you pay the interest rate for the funding which you don't really put to use. On Mintos Marketplace, you fund the loans on a loan-by-loan basis. So this funding volume very closely follows your origination volume. Secondly, the liquidity is really deep from this 30,000 plus investor base. We see that most of the loans get funded quickly within days or weeks. And we also believe that we do add value to the loan originators by providing access to retail investor base. The alternative lenders don't need any additional intermediaries when it comes to working with the professional investors. If there is a professional investor willing to allocate 5 million euros to a particular non-bank lender, you don't need another intermediary in between. However, if you wanted to fund the loans you're issuing from retail investors who would invest, let's say, 1,000 euros or so each, then probably it would be an entirely different ballpark in terms of dealing with those investors. And this is where Mintos can come in and provide access to this retail investor base. And we also believe that retail investors are much stickier than professional investors. Professional money is hot money. It comes in large volumes. It can go in large volumes in case there is some turmoil on the financial markets. Thirdly, it's really scalable. With the traditional funding sources, each new funding round, that's a new set of negotiations, new set of agreements, plenty of paperwork and effort to be done. With Mintos funding, once you have set up the initial connection to the marketplace, it's extremely scalable, and basically all you need to do is to place more loans to fund more loans. Finally, which is quite important for longer-term lenders, with the traditional balance sheet funding, there can be a mismatch between the maturity of your liabilities and maturity of your assets, which can create some sort of liquidity squeeze should there be problems to refinance some of your liabilities. With the Mintos funding, each loan is funded throughout to its maturity, so there is absolutely no maturity mismatch. So just to summarize where we are at the moment of our journey, we have 28 loan originators from all over the world. 330 million euros in loans have been funded. Something like 30 million euros of loans get funded each month, and we're still growing. So that's it, and looking forward for a fruitful discussion in the panel. And if you have any questions about how Mintos could be helpful for your alternative lending business, happy to discuss in the coffee break.
Thank you very much, Yannis. The last chart, the previous one, was very interesting. Congratulations.
Thanks.
Okay, we're moving over to Shridi.
Hi, good morning, everyone. Keep it short and brief so that we could have a discussion, I suppose.
As a way of introduction.
Yeah, so we represent AIR. I'm Srini, one of the co-founders and Chief Risk Officer. We're based in London, team of about 20 people. You could probably see most of the team over there in the picture. Why we are here? Well, Credit Bureau, as such you know, is about 56 years old. It used to be in the place where world was much more segregated. People don't tend to move a lot. You know, my older generations, like 2-3 generations before, they tend to be quite content and happy with where they are. But this is what the 21st century looks like. You have citizens in different types. You have self-employed people. You have people who got a much fluidity in terms of income. You have people who actually, take up a lot of gigs to maximize. And partly it's down to the recessionary effect, I suppose, where a lot of people who tend to have 30, 40-year-old employment, they've been pushed out, so they need to do something. And as a result of that, you have a very wide variety of scenarios. Are banks and financial institutions ready to serve that? Partly yes, partly no, because when you see a new generation coming through, the systems also need to evolve. So there's somewhere down the line, the credit bureaus are designed such that you have data collected from different parts of institutions, the utility companies, banks, you have energy companies probably in some aspects, telco, they all give you data, and then credit bureaus store the data, and then they give it back to the banks when they make a decision. What tends to happen is when you have no credit footprint, it tends to fail dramatically. When I say dramatic, in some parts you talk about no credit bureau in the market. Funnily, I worked in Poland through Credit Tech in the early days. So we sort of know what kind of bureau coverage in certain markets can be. The likes of markets like Poland, Spain, if you go to like Africa and India, it's literally non-existent. Only in the last 5 or 6 years, you got like big international bureaus trying to set up a show. So that's effectively the sort of problem we're trying to solve. So what we're trying to do is very simple. Put consumer right at the center of the equation. Our belief always has been, this center is called Copernicus Center. One of the great discoveries of Copernicus has been he put sun right at the center of epicenter of everything. We believe consumer need to be at the epicenter of everything because without consumer, there's no demand. You can have all the money printed in the world, which happened in the last decade, but there's no demand story, there's nothing to be provided. So what we are trying to do is engage with the consumer right at the heart of the process, where a consumer, an applicant goes to a website of a lender. It basically, a traditional credit bureaus basically get called. There's no data available. We get called as a kind of secondary portal at the moment. So the consumer interacts with the virtual interview. On the back of it, we push some results back to lenders via an API. API is just a simple gateway. We got authorized by FCA to provide authorized credit references in the UK market. As a company, we're about 4 years old. We are starting to look at overseas markets, mainly the likes of US and Australia. I've also been exploring markets like India and Africa, early days yet. In terms of the product, we've done about 5 billion notional volume in dollar terms. Effectively, anything that's, that a consumer needs, from a credit card to personal loans to car finance, we're looking at. APRs, as you probably know, it could go anywhere between 18 to 80% in a near prime world. So we're kind of looking at all the way from prime to near prime at the moment. We don't serve subprime. And the idea primarily is to help the consumers to avoid the kind of trap with the subprime loans provided by loan sharks. So that's it, just basically. We can jump on to discussion, I suppose.
Thank you very much for the introduction, gentlemen. Let's start by answering the question whether the financial markets are broadening or whether the fintechs are fintechs in the sense of small companies, upstart companies, or whether the fintechs are replacing traditional finance. And Tero started there, so if you could elaborate on your thoughts.
Sorry, the question is whether we are creating new market or replacing the old ones. So.
I'm sorry, before we go further, I've got the impression that we're not quite sitting in the right places, so perhaps let's switch so that we don't confuse the audience. Tero, if you could move over here, please.
Me? Okay.
Jan is in the middle. And Srini, you are the last one there. Swapping with David. Okay. That will put some order. Easier to...
Some order. Ordnung muss sein. Okay. Sorry, the question was?
Sorry. The question was whether with the alternative finance, whether the fintechs that you gentlemen work in and have an expert knowledge about such markets, such as your case, equity capital markets and investors' perspective, are you replacing traditional finance or are you broadening the financial market by adding some sub-segments that didn't exist before?
Well, I think disruption and new innovation typically starts from subscale. In a very small scale, somewhere which is like below the radar of the established players. And I think that's exactly what we are seeing. So what we are doing at Investor, we are doing ECM and ECM business, nothing more, nothing less. But we started by financing a broke young dude with a PowerPoint presentation and who wanted 50,000 euros. It goes without saying that Morgan Stanley would not have him in the offices for a minute. But we started there and we tested the platform, we developed it further, and now we are doing IPOs. And I think I was in London in the traditional capital markets until the financial crisis and shortly thereafter. I think until that time, the innovation was driven by the established players. Then became the financial crisis, then the regulators and politicians overreacted. Everything became very restricted, and then the traditional banks are now scared to death of doing anything new, or have been. So that created an opening for small startup companies that all we represent to create something new, like below the radar. And now it is a question mark. I cannot answer how it will develop from now on. Will we all be acquired by the likes of
We'll come to that at the end.
Yeah? Or will we start going to where you asked? Will we start replacing their businesses and challenge them head on? I don't know. But until now, we have been only like being complementary, being subscale in like small scale where they don't want to go.
Sure. Can you imagine equity capital markets, an IPO of, let's say, a Facebook in the future, entirely happening through a platform such as yours or a set of platforms at the same time, probably?
So you mean we would be doing Facebook IPO?
For instance, is it possible?
Well, they are public already, but we would be very much loving to do it.
Company of this size.
Well, if we go the path that I said is one of the alternatives, if we simply grow and become a big ECM player, then of course that's the intention. But like I said in my introduction, I think today's Altfin is just the normal banking of tomorrow. Yeah.
What about you, Yanis? What do you think? Are you replacing traditional finance as they are at the moment?
I would say that more we are actually complementing traditional finance. When you look at the, I mean, we have two sides to our business, investors and the loan originators. So looking at the loan originators, we work with 28 of them. Then when you look at their funding structure, it's not the case that they would be desperate for funding, that they would not have any external funding sources, which would imply that, well, they're totally underserved. And when they start funding their loans through Mintos Marketplace, we also don't see that Mintos would replace those existing sources of funding. So what Mintos provides those lenders with is additional flexibility. It enriches the funding structure. With that being said, I think it's fair to say that the non-bank lenders don't have the same access to funding as obviously the banks or even any other sector in the economy.
Sure, but is it really an advantage, this access to white banks? We remember Northern Rocks in 2008, which, because it was funded mostly in the wholesale financial markets, it just folded within 3 months when the liquidity disappeared. So I would say that not in every case access to a broad markets is an advantage. It may be a disadvantage.
Sure. I mean, if you're relying to very homogeneous sources of funding, then it can be a disadvantage. But certainly, if you are utilizing it wisely, then more choices obviously benefit you. So. And we haven't seen that the non-bank lenders have as many choices when it comes to funding as do the banks or any other sector in the economy.
Thank you very much. What are your thoughts, David? Remittances, cross-currency, and cross-country payments. That's your business
yeah, that's our business. So in our case, we're not replacing the traditional finance. In fact, we're basically broaden the portfolio of products offering from the banks, because a lot of our customers used to, because it's very expensive, because it's very inconvenient, they has to go to the parallel market or kind of like informal market to buy FX. If, for example, in Nigeria, where it's like a country crisis where you have scarcity of FX. So a lot of customers need to go to black market, need to do parallel market to actually get access to liquidity. So there we're providing a cheaper, easier, faster way to get that, and actually helping the government or helping the banks to claim those transactions back to the official channel, because from the consumer perspective, I'm still using the traditional banking infrastructure. I'm sending a wire from my bank to BitPasa's bank. It's just like on the back end, right now, the banks are not very good at communicating with each other, right? So they're using SWIFT. Like in Eurozone, you communicate with each other in Euro via SEPA. With SWIFT, banks communicate with each other through SWIFT. But what if a Mozambique bank want to communicate with a bank in China? Their language has to be dollar right now, but can I communicate with my Chinese bank in Mozambique, currency, vice versa? So in our case, it's pretty much complementary and actually formalizing the informal transaction, informal flow and it's quite huge, right? So, and I don't want to really focus on remittance because that's kind of the one of the product we offer, but bigger picture is really the B2B space, right? A lot of cross-border business going on, but nobody's actually serving them. And we have broadened the FX currency or FX products for traditional finance. That's our view. Yeah.
Thank you very much. Srini, you are in the data collection and data analytics business. Some of the companies, such as Facebook, data collection, and some of the companies, such as analysis, such as Equifax, didn't have a very good press lately. Do you feel powerful enough to replace them, to at least Equifax?
Yeah, I guess it's a hot topic, right? Information security and privacy. I guess it all boils down to what do you call like a company culture or corporate culture, right? When you serve a customer, it is at most that, no matter what's your balance sheet or like your EBIT look like, eventually it's the customer that you're looking to serve. So when it comes to setting up the governance and the culture, there's always these issues about, who basically has the data, who has the control over the data, etc. Part of the challenge has been when alternative finance systems starting to basically grow over the last few years, there wasn't a consistent framework in different markets. So if you are in one country you operate, you're probably much more tightly regulated by the likes of FCA, whereas you go to country B, people tend to use that as an arbitrage play between, okay, let's go into countries first, where there's hardly any regulation involved. We go through the market, make sure we raise enough money. By the time regulators comes in, go away. This is exactly what mortgage brokers do before crisis came. So I think, most of these like issues, one way or other, it could affect anyone. Equifax is at the forefront, but there could be a number of companies like pharmaceutical companies. We had a problem with the NHS who basically had a hack. In reality, I think the information security is going to be a much bigger problem than what people thought. It's basically the system need to respond. And I think it can be done together. So there shouldn't be any kind of, in-house firefighting where, people tend to blame other companies and become opportunistic. In some ways, I feel sorry for what happened with Equifax, but at the same time, behind every crisis, there's an opportunity to react, and that's how we should see it. With regards to, I guess, Facebook, it's also a question of, putting the principles in place where the consumers need to have much higher power in terms of where the data actually goes, where it resides. Now we are actually starting to see certain European data shouldn't actually leave the system. It shouldn't actually go somewhere else. But then there's always a political risk involved where if the company becomes systematically big enough, then of course the government is going to come back and then say, okay, how can I use it for the national security? So there needs to be a coherent, consistent message between governments to say, these are the things that we could be doing with the consumer data, no matter whether it's Facebook or any other company. It could be the same problem for us when we go to US. We operate in the UK today. When we go to US, what happens to the consumer data? We've been very, very careful. We've been speaking to the CFPB to see, where does the kind of boundary lie. It is something a fintech ecosystem needs a lot of support. I think the best way to do it is to speak with the European Commission, speak with the likes of regulators, get some good consensus on the policy and framework. That will make an entrepreneur's life a lot easier.
Thank you. We had a FinTech Open Mic night, credit scoring yesterday, which you unfortunately went on, and there was a question during the panel discussion about whether machine learning being quite expensive, both in terms of cost of data, you've got to acquire the data to run a good stats on it, to run advanced models. And I would like to ask whether, actually this is a question to all of you, whether you think that the fact that it's expensive to have advanced analytics, whether this puts larger companies at advantage compared to smaller upstart companies?
I can go first if you guys want. I guess ML or machine learning or artificial intelligence, you'll probably hear it in every single conference,
Let me stop you there for a second. I'm trying to answer the question whether actually large companies have a certain advantage that they keep them from dying, as the panel question is.
Well, actually, I think AI as such will not be expensive. It's computer power. I think
Data
access
is
to data, exactly.
And it's going to get harder after introduction of
Exactly.
GDPR.
There are huge economies of scale in the data business and platform business. So it will always be more difficult to replicate gathering the user base of Facebook. So I think data crunching will be commodity. Ability to use it, of course, will be intelligent, but then access to data, that's going to be expensive.
It is. It's becoming even more so. What do you think, Yanis?
I mean, in the platform business, I can only agree that the scale is crucial, and you don't need 20, 30, 40, 50 marketplaces, either for loans or for books or for any other product or service. So the same way that we see that there's one Amazon, there's one Airbnb, there's one Booking.com, eventually I think the same will apply for loan marketplaces. There's going to be only a few of them.
Okay, will the regulator allow this? I mean, we used to have lots of natural monopolies in the 60s, and most of them were broken. An example being the telecoms, which in the 90s, 80s and 90s were broken into oligopolies. And the regulator may just not allow this because the situation where there's one Facebook or one Google holding a data on everybody and very, very precise data, it's uncomfortable to many people.
I mean, that's an excellent question. So it's hard for me to comment on Facebook or Google, but when we look at the fintech industry, the marketplaces for loans, then I think we are just not that interesting to the regulators at the moment. I mean, even the volumes that have been achieved through peer-to-peer lending marketplaces or loan marketplaces, I mean, it's just scratching the surface in terms of what the banking sector, for example, is doing. So obviously there needs to be regulation, but thinking of whether the leading players should be broken down into smaller entities, I think we're like a very long way from that.
Sure. Okay.
Sorry.
Well, just commenting on that, I think, or your point on the national oligopolies or monopolies, I don't think they will really be a relevant issue in the future. Because like telecoms were created when actually they were national businesses. Yeah. Now all these platforms are cross-national, multinational. So we may have an oligopoly between Facebook, Google's and all those, or Lyft and Uber perhaps. But I think the oligopolies that will exist now are not going to be national. Some regulators would like that still to be the case, but it simply is not because technology is everywhere.
Sure. So go back to your question about partner or compete, right? So I personally I just very believe in partnership. So I know that this panel we need to kind of battle with traditional finance, but like before joining Bipesa, I was working for Barclays in Kenya, basically leading the incubation and accelerator program. And I think one of the challenges in so-called traditional finance or banking institution is about change management, right? So I can't really have a very efficient flow to build a product to serve my consumer. And this so-called alternative finance or fintech comes into play because they ship product faster. And then if we partner together, then we serve the customer better. And I think that's better for the broader economy rather than compete and like reinventing the wheel. So that's my personal belief. Yeah.
Some observers of the financial services are saying that in the future it's quite likely that because of the increased regulation, banks can be sort of pushed into a position of being an infrastructure, and all the front office function can be done by a certain fintech companies, if you like, operating on top of that infrastructure. Do you believe that is the future?
Yeah, so I'll give you an example, like Equity Bank in Kenya, because it's so difficult to innovate from the bank, because due to regulation, so they basically set up a subsidiary which is not restricted to this banking regulation as a technology company to basically reinvent, kind of rebuild this infrastructure to make consumer easier to adopt their products. I think that's already happening. I think that would be the future. Yeah.
I guess coming back to your first question about big companies versus small companies, I think the big companies like IBM, Amazon, they all kind of got their game right at the moment, right? They could be going and solving healthcare problems. They could be going and solving agriculture problems. IBM bought a weather company to actually aggregate all the data. there is a bit of vertical speciality that they miss in general, when you target really complex problems like credit or healthcare. There's a bit of a realistic adjustment made by big companies where they open up their infrastructure. So, pretty much most of the fintech companies, one way or other, they run on Google Cloud, Amazon Cloud. The question then becomes when you put it in a big banking infrastructure, which is much more core banking, is not about cloud. Even today, you get big banks who really get scared about cloud. And it takes time. So this is what you call the trade-off between you being fluid in the market and then the transition risk that you pose to an organization. So if you look at the board level in a big bank, one of the biggest kind of challenges they have is how do you make the bank resilient over the next 50-year period where you introduce these new technologies. Deutsche Bank is a good example where you have so many IT systems that are in place. How do you ensure you continuously serve the customers, both at the capital market and retail? At the same time, you actually ensure that you keep innovating. To me, I think that straight away answers the questions where if you can't do it all by yourself, you might as well partner with the companies who are very nimble because they are much more closer to the problem they're trying to solve. They're going to help you to make the transition in a seamless fashion. At the same time, the fintech companies also need to learn how to operate in a regulated environment as well. There's no place for companies who just build pure tech stack, and then if you don't have any security measures, etc., you get wiped out in a couple of years.
Okay. Anyone has more to add? Well, if not, then maybe let's move. Let's do some futurology and let's try to think where the financial markets or financial services industry is going over the next 5 years or so. Who would like to start with that?
Seconds. Yes.
Going for the microphone.
So to prepare for this question, I actually checked the Bitcoin price in 5 years exactly today, and I don't know how many of you actually know that. I'm not saying that for you to speculate, but I just want to mention that. So 5 years ago today, one Bitcoin is worth $12. And does anybody know how much it's worth right now? 4,000. So it's 4,300 in 5 years. So I'm not asking you to put your money in cryptocurrency, but I just want to mention that I think financial industry has been incumbent in a lot of traditional players for years, but now with this technology advancement and consumer demands, I think, and I feel like actually the reason why there's a lot of solution coming out is because consumers are experiencing like very, very fast advancement of other products they experience in life. So they start to expect the same experience when I used financial products, right? And that's where a lot of things has happened. And 5 years ago, like you won't even bother about Bitcoin or nobody talks about blockchain technology. And recently, like Goldman Sachs published a report on Fortune saying that they are thinking about trading it. The head of INF said that this could be the future of cryptocurrency, right? And Fidelity Bank also opened their exchange rate board and for their clients to actually see the Bitcoin price. And so this distributed ledger technology has gone from zero, and people say, it's scary, it's like doing human trafficking or like it's not compliant. Now it has become a real topic. And people are building their solution on top of that. So last year alone, there's over $2 billion invested in this type of ventures in blockchain technology. And liquidity has grown a lot. Like basically, in all the major continents, if you have a Bitcoin right now, you can basically liquidate that in local currency. And the application has gone more than just payment. It has gone to food supplies, land registry, and even the recent hottest topic, a new way of raising capital is initial coin offering. Again, there's a lot of different solutions, in the market. Some of them are not good. Some of them are probably a scammer, but some of them will survive and lead innovation for the future. So from our perspective, what I see is a hyper-growth stage for this technology to be adopted. Like World Bank, United Nations operations, they all have this blockchain lab where they want to be more blockchain ready. So we will see like a blockchain adoption in the coming years. That's kind of on our vertical, what's going to happen.
I think that's one of two very interesting questions. What will happen to how will blockchain and cryptocurrencies impact the world of banking? So before we answer your question, what will the banking look in or finance look in 5 years? That's one big uncertainty. What will blockchain and cryptocurrencies do? The other question I would raise is that, like you said, banks could be like plumbing or like commodity, and then value-added services and infrastructure like water or electricity, pipes. I think there we have two scenarios, very fascinating, like, and unusually regulators here are like on the front end of innovation or advancing the things. Like in Europe, we have this regulation where the banks are forced to open up their like customer data, and then exactly PSD2, and I like that. I think that's a good idea. I know it's fashionable just to say it's come from EU, it's bad, but I think this is a very good idea. Also, it's unique in the world. So if we take this, so let's say European scenario, then there will be small agile companies creating value-added services on top of the plumbing, the infrastructure of the banking system. And whether that is blockchain-based or not, that's another question. But then if this fails, for some reason it is a catastrophe, then the rest of the world will not follow, and we will end up in a situation where the economies of scale in gathering data will remain with the banks. Mm-hmm. And I don't know the answer to that question, but that is really what I see as being two key questions there. What happens to the blockchain and the cryptocurrencies, and then is open data from the banks or not?
Next 5 years.
Yeah, I mean, to me, the biggest question that's remaining throughout the world is, you know, what is the effect of like interest rate and what's the allocation of capital, right? We got used to living in this kind of 0% interest rate environment for a good number of years now. People are, you know, inadvertently they're getting scared of what did it look like in a 3 or 4% interest rate environment. But it's something we've seen in the past, but we don't seem to make that necessary foundational steps to actually, you know, be prepared for the rate rise. Now, most of these asset classes which you see in alternative finance, I think that one of the biggest risks is, if you're an investor, you're always in search of yield. Now, most of the money has gone into emerging market. Now there's been a pullback as soon as the greenback is starting to appreciate. Now, that allocation of capital which has gone into different asset classes, whether you talk about the insurance-linked securities on one side to a peer-to-peer loan like in an Indian or Chinese platform, that big shift of capital is likely to happen over the next 2-3 years, depending on the rate kind of dynamics between what's going to happen in the markets, in developed market and emerging market. There could be an interesting kind of, you know, scenarios in emerging market where sustainable growth at 6 or 7% is questionable. Sure. Now, there's only 1 or 2 markets which are trying to hit that 6 or 7%. So if you're a policymaker, you know, that to me is the kind of biggest worry. How do you ensure that you seamlessly make sure, you know, the capital doesn't flow out continuously, you know, from one place to
This is very interesting area. I mean, we're now speaking about macroeconomics, but I mean, I'm asking myself a question: whether policy regulators do they still have as much power as they did have 20 years ago? So, for instance, if we have so many fintech companies, if an investor from China can invest in a Danish company if he likes through Teros platform, you know, we will not have the situation where the capital is actually not pulled out of emerging market because there are alternative ways of that capital returning to emerging markets. But that's just a financial market issue. That's not so much fintech issue.
Yeah, possible, obviously.
These are my thoughts on this, that the regulators might just not have as much power as they did have 20 years ago.
Now, I would think it's the opposite. The regulators are likely to have much more say. I think the biggest challenge is when you have like big Chinese investors coming into European market and then looking at like land acquisitions, etc. I don't know if you've been following Syngenda's story. Mm-hmm. You know, the 7 billion like bond sale basically is hitting kind of, you know, stale winds, so they kind of had to pull back. Sure. I think partly down to it's the consistency among regulators. I think they're starting to actually get that act together. Mm-hmm. FCA has put through something in the fintech scene, now ASIC, the likes of JFSA. They're all kind of acting like a good level of like network in terms of sharing information. To me, that's most critical, or for fintech to survive, is to make sure all the regulators sort of speak same language. They kind of give out a good framework, which will allow the likes of banks and entrepreneurs to make it much more easier. Because you know, from country A to country B, you're not actually going from apple to pear. It's a simple derivative from A to B. If model works in country A, there's no reason why it shouldn't work in B.
Sure. Thank you very much. Yanis, on the next 5 years?
Yeah, I think Srini touched upon a very interesting issue, which is asset allocation. And what we believe is that the way these assets are allocated is changing significantly and will change. I mean, currently, let's say you have a pension fund which has its funding from the future pensioners, taxpayers. So then this pension fund invests in a fund of funds invests in a particular fund, and then this particular fund invests in a particular equity instrument or debt instrument. So there's plenty of intermediaries, which each of them obviously takes its cut. And with the proliferation of peer-to-peer lending, marketplace lending, crowdfunding, what basically happens is that the investor and the kind of recipient of the funding, they are much closer, and I do think that's going to continue. Obviously, the potential raise in interest rates to some extent lowers the kind of incentive to look for higher yields, but still, I think the yield differential is that significant that we'll going to see continuation of this trend. And the second trend that I would be seeing is that one of the speakers in the previous panel mentioned how the proportion of the lending is shifting from banking sector to the non-banking sector, and even in UK that was what, 6% of the SME lending, and
8 to 10 if I remember well.
Sorry?
8 to 10 if I remember well.
Yeah, and I mean even and that's one of the forerunners in terms of the peer-to-peer lending. If you look at the continental Europe, then we're still lagging behind. So the non-bank lenders have speed, convenience advantage. So I'm quite sure that we're going to see continued shift towards non-bank lending.
Sure. Thank you very much, gentlemen, for this discussion. Unfortunately, we have to stop now for a break. Well, we'll finish later, I think, because this is becoming very interesting. Thank you very much.
Thank you very much.